All right. Good afternoon, everyone. This is Rich with TMC. It is a minute past the top of the hour. We're going to go ahead and get started very shortly here with a session on a topic that has come up numerous times these last several weeks related to new company policies that you've either established or are planning to establish. Largely due in part to, a lot of the changes that have taken place these last 10 weeks. It's just been a regular occurrence really on these calls that we've been doing. If it's been related to, final verifications of employment or policies on appraisals or, verifying lenders are not in or going into forbearance, that just had a number of different members speak to different policies they've crafted. We've seen a lot of members of ours passing policies back and forth to one another to help each other out. And that is the topic that we have at hand today. And I'm lucky to have three excellent discussion leaders here to help lead the discussion for us today. I'm going to introduce the three of them right now, and we're going to go ahead and get started. Before I do that, really quickly, just want to remind everyone that your participation is highly encouraged. We mute everybody's lines just to remove the background noise, but feel free to use the chat or the Q&A function to voice your questions, your feedback, experiences you've had, good, bad, or indifferent. And also, we will distribute a copy of this recording as well as the present. We don't have a presentation for this one, it's all video. So a copy of the recording to everyone that registered at the conclusion of the call or in the morning at the latest. So with that, let's go ahead and get started. And I'm going to introduce our panelists here. And from First Guarantee Mortgage Corporation, their Chief Operating Officer, Sarah Gonzalez. Sarah, thank you for joining us.
Good afternoon, everyone.
With Success Mortgage Partners, they're president, the right title now, Allison?
Yeah.
That is awesome. So they're president, Allison Johnston.
Thank you. Hi.
And lastly, Melissa Langdale, who is the SVP Director of Mortgage at Right By You Mortgage, which is a division of Fidelity Bank in the Raleigh-Durham, North Carolina area. Melissa, thanks for joining us.
Hey, everybody. Thanks for having me.
Excellent. Well, let's go ahead and get started here. And again, the topic today is new company policies that you've established or plan to establish. And Allison, I'm going to start with you. You have a very extensive operational background, have led tens of sessions for us on different operational matters in person and virtually over the years. And I want to start with you, and I'd love to get your thoughts on some of the policies you put in place or are planning to on the operations side of the business.
Oh, sure. Thanks, Rich. So I'm sure many people are doing the verifications of employment 24 hours prior to closing. We started doing that. We also started doing things like building some automation to confirm that the borrower's employment or hours or income hasn't changed. So we have it in our process to when a file is going to be hitting underwriting before it's underwritten or right when it comes out, an automatic email will go to the borrower and co-borrower asking them to confirm their employment and hours if it's the same that was disclosed to us on the application. And we made it super easy for these borrowers. They can click a green box that says yes, that I confirm my employment is exactly the same, or if they click no, it means that something has changed in their employment or their income. So that's an automatic email once they check that no button that shows that it's different to go to the loan officer and the VVOE team that we've created, see if the borrower still qualifies, see if there's an issue with the loan. But the other thing that we do is not only the verification of employment a day prior to closing, and we do that 10-day rule too, but we're also doing it when we're locking the loan, just really to make sure that our pipeline is clean, we're hedging on loans that are going to be closing. So those are some things that we did really around that verification of employment.
Sorry, I had to unmute myself. Thank you, Allison. Business continuity policies. So this has been a big one. A lot of our members kind of got caught here. Maybe some of our smaller lenders, or, you know, it's something we've had a lot of members put in place. Plans, written formal plans to enact when things like what has just happened. Sarah, would love to hear from you on some of the things that you had in place possibly or have put in place over the course of the last few months here.
Yeah, sure. Thanks, Rich. So I'm sure everybody on the call has a business continuity plan. If not a minimal one, at least a pretty extensive one. I think we're used to dealing with national disasters and things of that nature. I also understand we have bankers on the call as well as IMBs and the differences between those two different entities. But from a FGMC perspective, I think, you know, again, we had a BCP plan that was already in place. We have hard hit areas like North Carolina, where we had some shops in Charlotte where we've had to kind of address some of those hurricanes and flooding and things of that nature in the past. But I think we're playing with a whole different ball game now. And really, as we started, you know, sending folks home, which about 98% of our staff is home now, you know, that was an exercise, a tabletop exercise that we had not necessarily done on a live basis. So as we started to gather news around what was happening worldwide, we certainly did those tests right before we actually sent everybody home. So again, not part of our really prior policy, but one of those things that now, lesson learned, we need to make sure that we have those tabletop exercises. You know, we run through the normal tornado, hurricane, flood, you know, possible chemical spill, but I think, you know, when you think about taking your whole entire organization down and not just one piece of it and having to send, you know, 99 to 100% of your staff remote, I think it's important to do those checks. We found out ways that we had to increase our bandwidth across our technology base, which would have been a nightmare if we had sent actually everybody home and nobody been able to work. So there were some of those things. I think one of the other things that we really kind of focused on as well is, you know, we've strictly had all of our MLOs in an office. And again, I know all of you have different thoughts around that, and some of you are banks, some of you are not banks. But from an FGMC perspective, you know, we were probably very conservative, where I know some states allow some of that work to already be done from home. So we really dug into that and really focused on updating our policy of like who is mandatory to be in the office versus who's not, based off of state licensing and requirements within those states. We also came up with a daily jurisdictional directive grid, which really kind of informed the entire organization as to what was happening by not only just state, but at the county level. Who was on a shelter in place, who was not, who was, you know, really tightened up, maybe doing some things that weren't necessarily at the federal level, but they wanted to tighten up a little more on the county level. So again, a lot of work went into that, but we holistically shared that throughout our organization, because now we're dealing with, you know, where can we close a loan? Where can we actually do an in-person closing versus, you know, having social distancing issue? We've heard of title companies, you know, putting the documents on the doorstep of the borrower and watching out the car window as they sign so that they can notarize those documents. So again, thinking about all of those things and just having kind of some foresight as to what that's going to look like on a daily basis, I think has really helped our organization get our arms around being able to be agile around those changes. You know, one of the things that maybe we haven't thought of, and I'll be honest, from an FGMC perspective, whoever thought we would need a return to work policy? And that is something we've embedded within our own BCP policy that really not is just a call to action to get everybody come back in your office, but take consideration around how you're going to do that. You know, some of the things we have personally thought about are tiering our employees. You know, remember the old high school days of having A lunch and B lunch? Well, making that applicable now in the workplace. You have your A employees and B employees, and then you have your A days and B days that are, you know, that are alternating between those employees. having a SWAT team that is actually helping drive some of those decisions, and when should we, actually go live with mandatory versus voluntary. So again, I can go through a plethora of things here that surround us. I don't want to hog up all the time, but I think, go back, take a look at your VCP policy, and really think through, not maybe just about the things that happened when we all went to home, but how are you going to return to work? How are you going to actually make sure that you embed a lot of the things that people are still going to want to see? Maybe not mandatory by your state or your county, but if you're thinking about your employees, how are you preparing for social distancing in your office? How are you preparing for people wearing masks? What are you doing with vendors that come in? Are you closing down your conference areas, things of that nature? Again, that was a big portion of a lot of the work that we've done internally, just to make sure that we're ready to go the next time that something like this may happen, which more than likely will happen again, and how we're going to rebound from it. Sorry, that was a mouthful.
No, thank you, Sarah. Melissa, you represent one of our depository member institutions, and having worked for a few depositories, I know how much banks love policies. What are some of the ones, I guess, that, I mean, you've been on a few calls, led calls related to credit risk, and, banks, obviously, like you guys, some of the product you're originating is for your portfolio. So it's your money, the bank very protective of that. What's some of the things that you put in place these last few months on the credit risk side, right by you?
So we're a little bit unique in the sense we really operate as a really small, lender, and then we also have portfolio products that we offer. So we've had to do some adjustments by what our investors are requiring, and then we have looked at portfolio products that can really fill in some of the gaps that the market just doesn't have today. As non-QM went away, we looked at different portfolio options that could help us fill that gap. And we still do 100% financing for professional jumbo loan borrowers. So if they're CPAs, attorneys, doctors, we still have that product available today. We still have 100% financing for first-time homebuyers available today as DPAs went away and that sort of thing. It gives us an opportunity to still fill a need in the marketplace. We're still keeping ourselves safe. We still have a very high credit threshold for what we have go through that. We have a minimum credit score of 700 on all of those products. So these are good credit borrowers that just for one reason or another, don't have liquid assets right now or don't want to use them. I think these particular products help us to fill that need.
Excellent. Thank you, Melissa.
We also still do construction financing as well, which is a whole nother layer of risk that we've had to manage through this. When you've done a construction loan for somebody 6 months ago and then today they don't have a job, it's been a whole, different realm for us to navigate. It's a little bit different, but we haven't discontinued the products because we still have, 80% of the market that is employed and moving through just fine.
Rich, if I can jump in, I would say, if you look at just overall credit policy and which includes some of the product development combined with capital markets, FGMC certainly paused the button on our non-QM products of Maverick Solutions, but also too, secondly, things of that nature. But then even when you look beyond that and just into credit policy, I know Allison covered off on a lot of those, being made flexibilities and maybe some internal overlays that we put on ourselves. But there's just a lot that has to be done fairly quickly, and being able to be agile into that. I am sure for those of you on the call, I know Melissa, Allison, you guys probably are faced with this too. It's like the minute, one of the decisions we had to make internally too was what were we going to program versus not program? What were we going to hit the pause button on versus not the pause button? Taking down materials from a marketing perspective. I think if you really thought about all the credit changes that happened over the course of the last, I would say 30 to 45 days, the minute you got them ready to program, it was like they already changed again. And so we had to make some decisions internally to say, you know what, we have a committee that governs, what we're doing in Encompass. But at this point, with all the credit changes and how agile we had to be for our customers, we ended up doing a lot of that stuff manually, which was like going back to old school. It was like, man, dust off your boots and figure out how you're going to do this manually and control it manually within your operations staff, because trying to make the changes through the system and putting in hard stops and soft stops and all that kind of stuff became extremely cumbersome. So, we certainly build the products and price them in OB and through our capital markets platform, but from a pure just credit perspective, a lot of that stuff we did manually, which is a risk, right? But you also have to kind of weigh out the time and money you spend on making those changes and then basically them negating themselves the minute you get them ready to go.
Thank you,
Yeah,
Sarah.
that was tough, Sarah. And the one thing too is just open communication with your sales team. I mean, that was one thing. We did town halls, we did videos. We were very transparent with the sales team of what was going on, because it was new territory for them. And all they know is, hey, I used to offer a 580 manufactured home, 55 DTI with repair escrows rolled in, and now I can't do anything with those loans. Or, or now the credit box is different, or the AUS engine has changed, and that AUS engine is now tighter. You're not getting the higher DTIs that you were getting. So even with changes that are coming, that you might be rolling back out, we always say we have it right now. We have no idea what's going to happen in the weeks to come. So I just think that we had to do some things manual. It was tough. We made the best decisions we could at the time. I wish I had a crystal ball, because I think I've aged 10 years in the last probably 45 days. But I think just keeping open communication with everybody that's involved, so everybody knows why we're making those changes too.
100% agree. Yeah, we actually updated our charters. We have tons of committees, as I'm sure all of you do. And we updated our credit committee charter. One, our charter basically says, like, we must meet in person this many times, a month or a year or whatnot, and who joins that committee, who's a voting member, who's a non-voting member. And I own that committee, and we changed that committee to basically say, look, we don't have time to be meeting in person. We're getting votes over email. We're going to add sales to the charter. Yes, they're probably going to complain about everything that we're doing here, but at least we can have that conversation on the phone, and we could talk them through like why we're doing, how you should be selling it. This is not potentially permanent, right? We're just sort of hitting the pause button on some of these things. And then also too, just around like looking at, okay, what do I do with current pipeline? What is locked versus not locked from a customer perspective? What's submitted versus not submitted? So there's a lot of that I think a lot of us have had to try to kind of reel in and try to make on the fly decisions about. But I think giving some of those flexibilities internally certainly help your firm.
So we've done the exact same thing. Because we're a community bank, we have a lot of commercial clients that go through our process. We're on any given month 30 to 40% self-employed borrowers. So one of the things we did was instead of the standard closing affidavit, has your income changed, we make them go through a different process and tell us how their business has been impacted, what reserves they have for their business to get through this, how they see themselves getting out of it. I mean, they're going into a lot of detail with us on, how things have been impacted and how they're planning on getting out of it. And it gives us the ability to, at the end of the day, be confident about the credit that we're giving to them. If their income is declined, it's okay. If they've got enough reserves to get through it and they're, traditionally, stable in their income stream, right? We recognize that this is a moment in time, but it gives us the ability to dig into it a little bit deeper. So that's one thing we've had to do that's, I know, a little bit different than some others, because our world is a little bit different, but it's a huge percentage of our pipeline we needed to tackle.
We, a new policy we just implemented, like literally within the last few days. And it's still being developed right now through IT, but, you know, I think time was a critical part of what has gone on over the last 60 days. So shrinking down the amount of time that it takes to get a loan from point A to point B all the way down through settlement in cap markets and on the secondary. And so by looking at some of those, you know, different roles, just from a pure credit perspective, you know, and maybe I'm behind the ball here, but we implemented a brand new policy that allows our processors and account managers for conventional loans to have some authority to clear conditions there, because, you know, if you think about all the amount of touches and the time that it takes to clear all those touches, it was sucking up time, of which I needed to cut down significantly in order to get that loan through the process as quickly as possible. While we're having to deal with forbearance and we're having to have all these multiple checkpoints and things of that nature, the ultimate goal is, right, to get that borrower where they needed to be and get them through closing and get that loan settled as quickly as possible if you're selling your loans.
Yeah, we ran into some, oh, go ahead, Rich.
Oh, no, go ahead, Allison.
I was just going to say, and I think people change their business model, right? So maybe people used to sell to the aggregators all the time, and now they've decided they're going to take more into their servicing portfolio and take a look at doing that and getting that established and in place and making sure you're boarding more loans. I know for us, we had a small servicing portfolio, and I would say we've probably increased that 70%, probably in the last 2 months. Just because, you know, if the aggregators are behind purchasing loans, they're 4 to 5, 6 weeks behind. A lot can happen in that 4 to 5, 6 weeks. So trying to turn your pipeline quicker in your warehouse lines, many lenders are now servicing more than they did before.
We had a call.
We don't necessarily service, but we have a sub-servicer that does a lot of the, obviously all the work for us. But, you know, we had to come up with some really quick ways to report out. I mean, you start one day and you think, oh my gosh, you know, this is our new normal, and we have really no visibility, right? And so there was this huge push to say, okay, these are all the things that we need to know. I think most of you are aware we have a huge port retention team, and you know, we had to have visibility into, you know, how we were going to deal with that, and know up front, right, from straight from the lead perspective, and looking at, you know, how do we expand our exclusionary list on some of those leads, but also to being able to follow that loan through all the way through the process, as well as right before it's sold, right? So giving us visibility on what's been sold and what is that level of risk and who is it with, but also on the stuff that's not sold and that's sitting there waiting to be, you know, either designated or settled with the particular investor. So again, you know, I think there's a lot of changes on the servicing side of which I'm not an expert at, but I know that, you know, holistically there's been a number of work, or a lot of work done on the servicing side to also keep up, similarly to operations and credit risk.
We had a call.
You may have more color on that. I'm not sure.
Melissa, the servicing side, anything that you put in place right by you on the servicing side of your operation?
We in our brilliant planning this year launched portfolio products in February. So we don't have a really big servicing platform. We luckily had already done everything we needed to know to be able to build out our portfolio. So we are in a good spot from a lot of things, right? We know what to do and how to get things through, and but we also don't have any trailing baggage with loans sitting that could fall out or, you know, could lose their jobs and need forbearance either. So we really, luckily, we're in this kind of sweet spot. But, you know, we don't have a huge servicing portfolio right now. So I don't know that I'm the best person to speak on that.
We had a call earlier this week. It was the whole call was just really related to just credit overlays related to like borrowers returning back to work, some of the changing employment stuff that's going on now. It was really good. And somebody brought up a great point that like your QC people are really the unsung heroes. They don't, they don't get a lot of the notoriety that, like underwriters, other operational positions do. But the discussion leader went on to just make the point that just, the importance of that role pre and post closing QC, and that, these last few months really was a referendum on how strong you were in those areas. We've talked about a number of different things that, have QC tentacles to it. Investor overlays, things changing quickly during the process, needing to do things late in the process and re-verify things. I'd be interested to get all your thoughts on, anything unique that you've done on the QC or, pre or post QC side, and just maybe how your mindset has changed a little bit towards QC these last couple months. So Melissa, I'll start with you.
We've doubled the amount of loans going through our pre-fund QC audit.
What percentage were you? Was it a 10 and 10? It was like when I was last a lender was, what is it now? Like 60 and 50 or something?
We did 15, so we've doubled it. So now 30% of our pipeline goes through pre-fund QC, which is great. It allows us to catch as much as we possibly can up front. We also are a little unique in our post-close process. Before we ship a loan, we also do a full audit of every loan that goes through, which is great. It gives us a 90% one-touch purchase rate with our investors. But it's allowed us to catch a lot of those things, and as things pop up, it's also allowed us to have that extra level of VOE before we ship it out as well.
Melissa? Allison, you touched on a few of these in your opening comments, but talk about some of the things you've done on the QC side these last few months.
We have increased our pre-fund, which has caught some things. And I would say for us, just because we offered so many different programs at one point, we offered all the DPA programs in the 29 states that we're in. Now we're just back to the core vanilla loans right now. We haven't rolled back out the DPAs just because we want to see how they're going to react if they're going to buy a loan in forbearance. Are they going to have any issues with that? Because, a DPA loan probably on the scratch and dent market probably will sell for 65 cents on the dollar, 70 cents on the dollar. So we did increase our pre-fund. We are having the VOEs done, so we had to quickly make a team, right? So everybody took their assistance, people without mortgage experience. We pulled it together to do that VOE, but I would say we're also doing more pre-funding. We're also doing on the post-close side, we review the closing package as well, just because if we're delivering it to the aggregator, we want to make sure by the time we deliver it, that borrower is still working, because the investor is going to check and make sure that the borrower is still employed before they buy it. And we don't want an issue where we're going to have any type of repurchase. So we've had to get very creative with our staff and moving people around. Some underwriters are doing more QC functions, and we also do third party. We have a third party that does some QC, but we definitely have been focusing really on the quality and making sure those borrowers will make their payments.
Thanks, Allison. And Sarah?
I think very similar to Allison. We have about a 80-20 split, 80% being outsourced to a third party for both pre-fund QA and post-close QC. We have heightened the amount we're doing on the pre-fund. Post-close, we'll have to wait and see. We're about 90 days out on that, so we're getting February results now. So I think you'll see that start to come to life a little bit as we get further down the road, but which is where all those manual credit guidelines are going to get checked. But on the pre-fund side, certainly same sorts of things, right? Higher amounts of volume, certainly more focused on those verification employments and things of that nature, which, by the way, we do also through a third-party vendor. So a lot of the same things that Melissa and Allison shared. I do know that from a post-closing perspective, we are certainly reduced the amount of time. So our goal historically has been, insure loans under 60 days. That's the goal. We have our new goal right now is 30, and we've already obtained that. So we're making sure that we're insuring loans within 30 days. It mitigates some of that risk. On some of our JMA relationships, we're doing the VBOEs at post-closing as well, because we're sending attestations that those borrowers are employed as well as not in some sort of forbearance plan. So again, a lot of things that we haven't really traditionally done in the past. I think the post-closing insuring guarantee piece is definitely a high note, and we'll continue that even after this is all said and done. But it's definitely helped us in being able to shrink in that time frame, as I was talking about earlier. So.
Thanks, Sarah. Talking about areas of your operation that, really at times like this reveal how strong you are, the capital market side of it. It's especially out of the gate in late March, it was the Wild West. I mean, it was just crazy what was going on. And we saw some of our members that had really strong, sound cap markets leaders and desks. Others that, maybe didn't, that had some very nervous weeks. Allison, your head of cap markets leads a recurring call
She does.
Wednesdays, and Victoria, and so we know you have a good cap markets professional at your firm. Talk a little bit about some of the things you put in place on the capital markets side of the operation.
Well, that fun time in March, but what we really have done is changed our hedging strategy a little bit. We're not covering our pipeline as much as we would. And I think one thing that was different for us is every day, and now it's every other day, but since the end of March, myself, Victoria, and Owen get on a call every single day at 9:30 for 30 minutes. What coverage do we have? What are we selling today? What is the market doing? Are there any margin calls, any settlements, any issues? What's going on, with any programs that we've suspended? Should we pull them back? And I think really going through this, it does show how strong your capital markets department is, but it also shows that, we have to be flexible and make changes. And I think the way that we've done secondary in the past for us, if we were hedging on everything on our pipeline, we are definitely doing that differently now. And I don't think we're going to go back to the way we were doing it previously. So I think just the involvement with the executive team every single day, know what's going on in the market, know exactly what we're trading and selling and what we're going to sell to the aggregators, what we're going to service. That was a big change for us, because usually we would make those decisions when we would allocate, but Owen's much more involved in that now. I'm much more involved in that now. And Victoria is super strong, but we wanted to make sure we were involved in it, because a lot of those things we had to make company decisions on. So for us, it worked out well. And I think I know more about secondary marketing in the last 6 weeks than I care to know, but it was definitely worth it. And Victoria has done a fantastic job for us.
Just don't give her any assignments at 4 p.m. Eastern on Wednesdays.
No, I know. She's blocked off.
Good. Sarah, when you hear the word marketing, most people think ads and social media, but there's external marketing, there's internal marketing. You have quickly changing business climate. It's important to communicate not only with your customers, but your employees in a multiple number of ways effectively. Talk about some of the changes you've made just with communication outward, externally and internally.
Yeah, sure, thanks. So obviously the big one is us pausing our Maverick Solutions. Anybody that follows FGMC on any kind of social media platform knows that that was kind of our big item that we did from a marketing perspective, if you think about just visually and promoting those products. But there's so much more, to Rich's point, to marketing, and my team has done a fantastic job doing that. The person that heads marketing, Brittany Whitmire, she's absolutely fabulous. Nobody on this call better ever steal her. But she has done a really good job, and I manage our lead buy. We have a strategy around that, how we're going to allocate those costs. Like I spoke earlier, we have a huge port retention. We have a number of JMAs that are going on. And so as some of this stuff started to play out, I basically turned off a lot of our MTA spend basically down to zero, and really got hyper-focused on our port retention and JMA relationships, which really wasn't a part of our initial strategy at the beginning of the year. So that was a shift overall. And again, we're in the middle of trying to onboard another JMA relationship. So again, it kind of frees up some of our time to do some of that stuff. I've heard some rumblings now on some of the MBA numbers that purchase money is going to start re-entering back into the market. And I think where originally a lot of us got news that it's refi boom. I still think that's going to be the case with the rates, but I guess we'll see on the purchase money if that plays out as it's being described. I think most of everybody has this today. It's a corporate communication strategy, and whether or not you have a person that's focused on that or not, you usually have a cadence of what you're discussing, what is the cadence of those discussions, and are they primarily just focused on like, okay, compliance training is coming up. So one of the things that we changed just with COVID was we completely adopted the strategy that communication is going to be key through this period. And so we wanted to make sure people knew, that we were listening, we were polling our employees, we put together a COVID bulletin every single day that not only talked about happy stuff, and a lot of our polls sometimes were funny in nature, like what's your favorite Halloween candy that you're munching on now since, you're back at home. But a lot of it was also based off of, how often are you meeting with your manager? I think it was important because outside of just the communication strategy with your organization, it's also important that you're making sure you're communicating internally with your teams, and marketing is really kind of the driving aspect of like setting those expectations with the employees. So, polling on, are you meeting with your manager, one-on-ones every day, once a month, never? And it really gave us some insight as to how we should stay connected with folks. Obviously being remote can be vulnerable sometimes. We started a new social media campaign called Maverick Strong. And it was really surrounded around COVID resilience and like really recognizing those folks that are still continuing to lead the pack and set a good example. So we continue to do that as well. And again, we are certainly driving a bunch of different things in marketing, but I think the thing that stands out to me the most is just being able to be communicative in a way that we've never been before, and getting information out as quickly as possible, letting people know what to expect and when to expect it. I think all of us really care about the health and well-being of our employees, and I think it's important we tell them that on a pretty frequent basis.
Thanks, Sarah. Another aspect of the mortgage lending business that's really come under big focus, subservicers. So many of our members use a subservicer with all the employment disruption and forbearance policies. It really was vital that you have a strong subservicer and you have a strong relationship with them. And I've had a lot of our lenders that have put in place policies or additional procedures to kind of supplement what their subservicer is doing on their behalf. Melissa, I know you guys use a subservicer. What are some of the things you did in that area? No?
No, I built it all myself. I wanted my hands all around it if we were going to do it. So yeah, we do not have a subservicer right now. We do it all internally.
Allison, you guys use a subservicer.
We do.
All right.
We have a handful of people that are in our servicing team, right? So they're handling some customer calls, but I would say they're on the phone with our representative from our subservicer every single day. So years ago when we got our Fannie ticket, it was so funny because they're like, well, you need to have somebody that has servicing experience, hardcore servicing experience, because you have to make sure your subservicer is doing what they're supposed to. And that is a true statement. So we were fortunate because the gal that we have did servicing for about 20 years. So I would say we're much more in tune, getting more reports than we have before, having conference calls with them, really getting a handle on our servicing portfolio to find out which loans have gone into forbearance, listening to the phone conversations that they're having with our customers as the subservicer. So we are way more in tune with our subservicer because we're boarding way more loans as well, where before we had such a small servicing portfolio, but now since it's pretty much tripled in size in the last couple months. I would say we're very much more in touch with them.
Thanks, Allison. The policy that has been passed around the most by our lenders is, Sarah, you mentioned earlier, a return to work policy. Who thought you'd ever need one of those? A lot of our members didn't even have work from home policies. We did a number of sessions in late March and throughout April on managing remote employees, for employees, being productive, working from the home environment. And on almost all those calls, work from home policies came up. It was really revealed a lot of our members didn't have one. So I'd like to hear what, from all three of you guys, if you had a work from home policy previously. If not, maybe some of the, did you enact one and some of the things that were a part of that? Allison, I'll start with you.
We had some employees that worked from home, so we had a work from home policy, but our home office, we probably had about 183 people that we had to go remote. We're still in a shelter and stay in Michigan. So we really had to have our IT team make sure that everybody can remote in, that we can check their productivity, making sure that we're watching to make sure they're not going to websites they're not supposed to be going to that could be potentially harmful, and then just offering training on making sure that you're not clicking on an email because, phishing now is huge with COVID-19, all the emails that they're getting, and just really doing education for our employees way more now since they're remote, and doing a lot of Zoom meetings and, just being able to see them and keep them motivated because it is hard when you're closing record volume and everybody's remote. Your managers are remote, your teams are remote. So we did have to, on the IT side, kind of kick that up a little bit. But we did have a work from home policy before.
Sarah, you mentioned a good percentage of your staff was remote. I'm imagining you had a work from home policy. You mentioned a return to work policy. I'm curious what that encompasses.
Yeah, so, on the just overall work from home policy prior to COVID-19, if anybody remembers FGMC pre-18, everybody was remote. It was the most dispersed company I'd ever seen when I arrived in 18. And so we did a lot of work between 18 and 19, centralizing fulfillment, bringing everybody back in-house, and then bam, COVID hits. So our transition to what our previous policy was, which was a 35-mile radius. If you were outside of a 35-mile radius, then you could qualify for a work from home position. And there was an exception process baked into that policy as well. So whether you like it or not, that was our policy. And then certainly when COVID hit, we changed that, right? We're about 98% remote today. From just a return to work perspective, again, I think, I talked a little bit about this earlier and certainly don't want to rattle on forever, but, I think the approach has to be extremely gentle and sensitive to employees because while somebody in your staff may not have, may want to be in the office, right? You have a lot of folks that have childcare issues or school still in session and they're teaching and working a full-time job. There's people that are just darn scared. Like I still wear gloves and a mask when I go out to the grocery store and everybody else is not. So, you still have these people that are very leery about coming back into the office. So I think you have to be really sensitive on what your designation is, on whether it's mandatory or non-mandatory. So again, that should be part of your return to work policy. We talked about tiering employees earlier and setting that kind of live date of when you're going to do that and how you're going to designate those employees. And then, what are your business needs? What are your customer needs? One of the things that we found, which I'm not quite sure why it's a big surprise, but I guess it is a big surprise. People are more productive at home. They, most of my retail staff have a 2-hour commute every day. They have a 1 hour home or 1 hour to office and 1 hour to home. And now that time is used to work, right? So they don't have to spend an hour in the morning getting ready to come into work. So, shave off 30 minutes from that. You get the 2-hour commute time. That's great. And again, you have to be really careful about working people too much, but at the same time, they feel comfortable because they're in their home. I think all of us on this call, do that already. Long-term considerations, what happens if another insurgence of the pandemic comes back, which is extremely likely. How do we handle that? We talked about the task force already. What are some potential long-term work from home policies? So like, remember that old 35-mile policy we have? That's probably going to get changed, right? It's going to be more flexible in nature. It's going to account for not just COVID, but like what happens if something else big happens and we need to be prepared for. Health screening, when do you do that and when do you not do that? How often do you do it? How do you hire somebody to do that, or your receptionist doing that? I mean, there's just a lot of things to think about if you're doing those types of things. Making sure that you have supplies available for your employees. How often are you willing to supply that for? Is it forever or whatnot? I think most of us have hand sanitizer, but go out and try to find that on Amazon now. That's really tough. So I think just being prepared for those things. Corporate travel ban is a big part of that. I don't think I've ever in my history, 20 plus years, have I ever been put on a travel ban by a company. So, when is the time to initiate that, which I think most companies did a really good job of. But there were some folks still traveling, and I'd hear noise about people coming from California, which was a really hard hit state, from conferences, and then be scared to death that they had somehow contracted that. So again, really understanding like when you're going to put that travel ban into effect, and then on a return to work basis, when are you willing to take the risk to open it back up? And then what do you do about people that don't necessarily want to follow a corporate travel ban, but they want to personally go to Hawaii or whatever on vacation in June? Like, how are you making sure that you're aware where people have been and things of that nature? So again, it's this very delicate line of like privacy and being able to make sure that you're putting your employee first. But those are all things like we're really considering through these return to work policies.
Thanks, Sarah.
One thing we talk about a lot is that this gives us an opportunity to become better leaders, right? Like, we've never had to lead through something like this, and we get an opportunity to think and feel, what our teammates and associates are going through in a very different way. We do have to accommodate, all of those things that Sarah just said. On the bank side, it's a little unique because traditionally wearing face coverings in a bank branch is considered a bad thing. So we've had to think through how we let customers back into some of our branches. And so, there's all sorts of other layers to it in our world of, the fear of the disease and the safety of our associates too.
I could tell you this, chief risk officers all across America have been justified. The last bank I was at, I had a good, but, tenuous relationship with our chief risk officer. And I've been emailing him these last couple of months, like, you're totally justified now. Like, all these policies I made fun of and said we'd never need, they are definitely necessary. So how is Melissa, I'm just curious, our depository members, not as much work from home, how are they, I'm just curious how they're viewing, having your staff remote, the productivity gains and how they're viewing like the return and just all that.
It's been fun to watch because our collab lab that's filled with community bank members, we had that conversation in New Orleans, and I think 90% of the room, right, all said that most of their people were in the office all the time, right? And it's been funny to kind of watch. Obviously, the majority of us required people to go home through all of this, and most of them have seen an increase in productivity. They've seen an increase in just happiness of their team, and as long as you can be intentional about your communication, be intentional about connectivity in your team, those sort of things, it can create a really good environment. So most of them right now are considering opportunities to look at a balance, whether it's, you know, allowing for some employees to work from home permanently, or I know one organization that allows people to rotate one day a week. You know, if a department, and it's funny, they stagger it, so not everybody can have Monday and not everybody can have Friday, but, you know, they as a department get to decide who takes what day, and as long as 50% of the department is in the office at any given time, then they're allowed to divvy up the days that they have other than that. So it's been interesting to see a lot of the banks take a different approach to this as they've seen, like I said, productivity increase and just overall happiness in their associates.
Absolutely. Excellent. Well, we are out of time, but this was a fabulous and insightful conversation. Sarah and Allison and Melissa, thank you again. You guys have all led sessions for us in the past, these last couple of months. Appreciate you guys taking some time out to do it again today.
Absolutely.
Thank you.
For the opportunity.
Thank you.
Hope to see you guys all somewhere in person at some point this calendar year. So, and Reese peanut butter eggs, Sarah, my #1 go-to candy. So yeah, I almost overdosed on them in April. So it was, but
Those are the best.
oh, they're so good. And thank you to the attendees. Not lost on us how busy things are. Really appreciate you taking some time out. We'll be sending this recording out to all the registrants in the morning. And really appreciate you joining us. And we'll see you again soon. Thanks and have a great afternoon, everyone.
Thank
Bye,
you.
everyone.
Thanks.